Hi all, good evening and welcome. I am Ridil Mishra from the Corporate Communication team, and on behalf of CareEdge, welcome you to our today's discussion on debt mutual funds. We sincerely appreciate your time in joining us for this webinar. I would like to welcome our esteemed guest speakers for today. We have with us Mr. Amit Tripathi, CIO, Fixed Income, Nippon India Mutual Fund. Mr. Rajeev Radhakrishnan, CIO, Fixed Income, SBI Mutual Fund. Our third panelist, Mr. Avnish Jain, has not joined in yet. He'll be joining in some time. The session will be moderated by Mr. Sachin Gupta, who is the Chief Rating Officer at CareEdge. We will commence this session with a presentation by Geeta Chainani, who is the Assistant Director at CareEdge. This will be followed by a panel discussion. We'll have a Q&A session with the audience at the end of the discussion. In case of any queries, you are please requested to key in your individual panel. Now, may I invite Geeta to begin the presentation, please?
Thank you, Mradul. Good evening, everyone. I'm Geeta Chainani from CareEdge, and today our topic of discussion is trends within the debt mutual funds industry, followed by CareEdge outlook on the sector. The key takeaways of today's presentation are sector facing headwinds amid credit crisis, COVID-19 disruptions, regulatory changes, followed by the current cycle of rising interest rates. Debt fund share on decline since December 2020. Debt funds investment preference towards entities with strong parentage. Reducing concentration towards single largest exposure. Rating-wise migration, sectoral mix, reduced single exposure concentration, and duration risks suggesting rising priority of safety and liquidity over returns. First, we shall discuss the fund inflows and AUM trends. Outflows continue, debt mutual fund share declines. Debt mutual funds have been facing headwinds amid credit crisis, COVID-19-led liquidity disruptions, regulatory changes followed by the current cycle of rising interest rates. If we look at the chart to the left, debt mutual funds have witnessed outflows in 8 out of the last 13 quarters, as a result of which the share of debt mutual fund AUM as a percentage of total mutual fund industry AUM has been consistently declining since March 20. From 53% to 35% by end of June 22. While some proportion of declining mix can be attributed to rising valuations of equity mutual funds, absolute AUMs of debt mutual funds have been declining post-December 20. Further, rising bond yields since second half of FY22, the recent 140 basis hikes in policy rates, expectations of further rate hikes, as well as muted to negative returns over the past few months have contributed to outflows from debt mutual funds. Rising interest rates propelling shift towards liquid funds. Within the debt mutual funds, overnight and liquid fund share has increased over the last few months on account of rise in interest rates, expectation of further hikes, coupled with volatility in other asset classes. Since December 21, the weighted average GSEC yields across 1, 3, and 10-year maturities have increased by 193 basis, 183 basis, and 97 basis respectively. Coming to the issuance trends in the industry. Issuance rated AA and below continue to rise. As per SEBI data, the fundraising by listed companies through private placement of corporate bonds declined by 24% in FY22 to rupees 5.88 lakh crore from rupees 7.71 lakh crore, owing to capital raising via equity route and fund dispersal by banks at competitive rates. In terms of issuer type, placements from banks and PSUs declined by 21% and 50% respectively, while issuances from manufacturing companies declined by 8%. As better-rated corporates shifted towards bank borrowings, issuances from NBFCs, on the other hand, grew by 23% year-on-year, as uptick in credit demand led to non-bank finance companies tapping the market to garner funds. As a result, the share of private debt placements by banks and PSUs declined to 42% and 9% respectively during FY22 vis-à-vis the previous year. Prime borrowers largely continued borrowing from banks, which offered funding at cheaper rates due to surplus liquidity. As a result, if we look to the chart to the right, in terms of credit rating category, private placement by issuers rated AAA declined, while issuances by AA rated issuers increased. Coming to the key mutual fund industry trends. Investments in G-SECs gain momentum, driven by liquidity infusion by global central banks and host of domestic monetary stimulus by RBI. Overall interest rates started declining post-March 2020. Availability of ample domestic liquidity and muted credit growth further resulted in spreads contraction between G-SECs and corporate paper. AAA rated spreads over 1 year and 5 year G-SECs, which were hovering around 84 basis and 112 basis, respectively, in Feb 2020, have been declining and were around 13 basis and 27 basis in June 22. Given the narrowing of spreads between the corporate and G-SEC, the deployment of debt funds into G-SECs have been rising, with the same into corporates, while the same into corporates have been declining. Reduction in single corporate concentration. Owing to credit crisis, regulatory changes, and increased risk aversion, concentration of top single corporate exposure has been reducing across different debt schemes and categories post-June 2020. Risk of sentiment leads to higher mix of safer securities. Similarly, within the schemes, there has been a visible shift towards safer and liquid investments. Speaking of the rating mix within the liquid funds, which is the chart to our left, proportion of AAA and sovereign assets has continued to stay high in the range of roughly 80 to 85%. While the investments have been mapped into the long-term ratings for better understanding of the underlying credit risk, the funds are mainly invested in liquid A1+ instruments. Within the medium-term duration funds, which is the chart to our right, while there has been a visible rise in investments into sovereign and corporate debt paper up to AA+, investments rated AA and lower have been declining, which has largely been contributed by declining risk-reward trade-offs and increased risk aversion. Unwinding duration risk. After declining during the first 9 months of FY21, G-SEC yields started inching up across maturities on account of higher than anticipated rise in fiscal deficits in FY21 and 22, thereby resulting into declining durations across debt schemes and categories. Consistent improvement in the stability of ratings. Within this backdrop of risk aversion and movement into safer securities, data pertaining to investment grade category, sharp downgrades as a percentage to opening investment grade portfolio also demonstrates an improvement. As seen in the graph, sharp downgrades for CareEdge have declined significantly post FY20. The pattern for other rating agencies is also similar, wherein in some cases improvement have been visible post FY21. Coming to the outlook, private bond placements expected to pick up during second half of FY23 may rise by 10 to 15%. As per CareEdge survey, bulk of entities in the BFSI space have been borrowing from banks during FY23 so far, will look to borrow from capital markets as the rates peak. As the credit growth returns, debt mutual funds exposure to the BFSI sector is expected to rise in the near to medium term. Higher exposure to safer credits likely to continue, driven by investor risk averseness. That's all from my side. Thank you all for your time. Over to you, Mridul.
Thank you, Geeta. Now, may I invite Mr. Sachin Gupta to take over the session, please? Sachin is the Chief Rating Officer and Executive Director at Care Ratings and has over 22 years of experience in leadership positions across the credit rating business. Prior to joining Care Ratings, he worked as Senior Director at CRISIL and managed the corporate and infra ratings. Over to you, sir.
Yeah, thanks, Mridul. Thanks a lot. So we can start the panel discussion. Before that, I would like to just do a quick introduction of our panel. We have with us Mr. Rajeev Radhakrishnan. He is the Chief Investment Officer for Fixed Income at SBI Mutual Fund. Rajeev joined SBI Funds Management Limited in 2008 as a fixed income fund manager, and he's currently CIO and directly manages a number of funds. Prior to joining SBI Mutual Funds, Rajeev was a co-fund manager, fixed income with UTI Asset Management for 7 years. A very warm welcome, Rajeev. We also have with us Amit Tripathi. He is the Chief Investment Officer for Fixed Income at Nippon India Mutual Fund. Amit has over 25 years of experience in capital markets, and he has been with Nippon for around 19 years and has successfully managed various fixed income and hybrid funds, which have been recognized for superior performance both nationally and internationally. In his current role as CIO Fixed Income, he leads a team of 20 experienced fixed income professionals. We also had scheduled Mr. Avnish Jain to join us. I think he's running a little late, so I'll anyways introduce him and maybe let's see if he's able to join us. Avnish is the head fixed income at Canara Robeco Asset Management Company, and he has over 28 years of experience in treasury and fixed income markets. He's been associated with Canara Robeco since September 2013, and prior to this, he was working as a senior fund manager with ICICI Prudential. At Canara Robeco AMC, Avnish is instrumental for overall investment strategy as well as execution for all the fixed income funds. And he has extensive experience on the dealing side, and he follows active investment management style. He holds a BTech honors from IIT Kharagpur and PGDM from IIM Kolkata. So a very warm welcome to all esteemed panelists. In the brief presentation that we had, the main theme that is really coming out is really the risk aversion in some ways of the fixed income side of the mutual fund. So maybe my first question, I can get Amit into the conversation. Amit, how is that true that the market is completely in the mutual fund side, on the fixed income side especially? There is a clear fixed aversion to the risk. And do you see that changing in the near future in terms of going maybe down the credit spectrum?
So, Sachin, you're asking from AMC standpoint or from an investor standpoint?
From an investor. No, in terms of when we see the portfolios of most of the AMCs, when I see and we do a trend analysis, we clearly see that the most of the mutual funds are more comfortable investing in GSECs and the AAAs, or even AAs, which are PSU AAs, but not the more the typical corporate credit is kind of getting missed out. So in that sense, there is a risk aversion, I would say, of the mutual funds to go down the credit spectrum. So that is a question in terms of how do you see it playing out going forward?
So I guess it's a story of two parts, Sachin, really. So let me put it this way, that as far as the basic risk appetite in terms of improving environment is concerned, and hence a reaction to that improvement environment is concerned, that appetite has been slowly coming back since the beginning of last year itself. And after the initial scare of the first wave of COVID, I don't think most of the AMCs would have looked at the environment and said that they want to necessarily avoid any kind of risk exposure. But there are 3 or 4 other things that have happened which also get reflected in the portfolio. First of all, the credit story is essentially a spread story. So if you actually go back to the beginning of the last 12 to 15 months, you had excellent spreads available even in the so-called non-credit space. So even in the AAA and AA space, you had a huge amount of credit available in terms of spreads. You look at structured AAA assets in the REIT and InvIT space, you look at select AA spreads, etc. That was available. So that was duly captured by the mutual fund industry. it is a matter of fact that credit risk funds, if you were to look at credit appetite in a narrow prism of credit risk fund AUMs, that AUM has not grown. But I don't think that inherently reflects the credit risk appetite of the industry. It is more about how flows have happened, and ultimately, since each product in the mutual fund industry is positioned for a certain combination of credit and duration risk, depending on how flows have happened, these products have got populated. In the last 6 to 8 months, though, or rather, I would stretch it slightly beyond that also, in many of these instances, even spreads have become unattractive for you to take a credit view or incremental credit risk because you're not getting paid for it. So essentially, what started as a backdrop of widened spreads late 2020, early 2021, became very narrow going forward as we moved into 2021, owing to huge liquidity, TLTRO, corporates consciously avoiding to borrow in the system, so on and so forth. To that extent, where, as the earlier presentation was suggesting, spreads are at all-time low. So you don't unnecessarily add on risk when the risk is not paying you adequately for that. So that's the other thing. The third thing, which is partly correct in terms of what you alluded to, is the optics part of it. It is true that while the markets had started stabilizing in terms of spreads as early as late 2020, investor risk appetite from a credit risk perspective has started improving gradually in the last 12 months. And that got reflected in the way how portfolios saw flows, where most of the flows came to high-grade products, and how the optics around that was also looked at in terms of the allocation to sovereign and AAA versus non-AAA. So I guess these are a combination of 3-4 factors, but I don't think it's a question of outright risk appetite as far as credit risk appetite is concerned, whether in the mutual fund industry or for that matter now, whether in the investor community. It is only with the narrow spectrum of possibly flows into credit risk funds that we look at this issue, that this becomes, a slightly larger issue than what it is. So let's not forget the fact that close to 75,000 crores worth of direct bond buying has happened. A huge amount of retail investor base is today buying things like ELDs and direct bonds, etc. Some amount of money has also moved, as the earlier presentation also suggested, because of the buoyancy in equity markets. People have preferred to take that risk vis-a-vis credit risk. And as that cycle peaks out, the appetite will come back. So I think risk appetite is there. In fact, risk appetite at the margin has improved. And it's a matter of time that we see the flow part also improving into credit risk funds. And as far as across the board funds are concerned, our buying of spreads is dependent on the quantum of spreads that we get for a particular quality. If that becomes adequate, you will see the industry coming back reasonably well into these spread papers, whether it is AAA, AA, single A, or whatever you call it.
Got it. Thanks, Amit. I think it was very helpful. Yeah, it's a very fine point that you made, that it's largely the risk-return trade-off, which is in some ways not favorable for mutual funds or any investor for that matter to take that extra risk and go down the credit spectrum. So let me get Mr. Rajeev Radhakrishnan into the conversation. So Rajeev, let's kind of step back to a minute, and in some ways, Amit was also alluding to it, is in terms of the overall attractiveness of the fixed income schemes in general, in terms of the overall AUMs that we see. So there again, we have seen a bit of a reduction, while there could be various reasons for that. And when I look at that number, 12, 13, 14, 15 lakh crores is the kind of fixed income AUMs that we see. But when I compare it to, say, a product like, say, a typical bank FD, that number is at least 10 times of that, if not more. So are we seeing, and I'm just putting it in the context of, fair bit of advertising and, a pull which is kind of being created for in general for mutual funds. So are we seeing going forward, attractiveness of mutual fund fixed income schemes increasing, and maybe, safe money, which maybe as of now is kind of, lying in bank FDs, and where again, till very recently, the returns were extremely low, in some ways moving more in a more pronounced manner into fixed income schemes?
Yeah, thanks, Sachin. So you're right from the perspective that, in terms of potential opportunity, when you compare with where, the amount of bank deposits that the system has, and the AUMs under various category of debt funds. The opportunity in a way for the industry and as well as for retail investors to start coming into fixed income products is quite substantial. I think a lot of enablers are already there. I think we are seeing signs that investors, especially at the retail level, they're incrementally getting all the more comfortable investing in fixed income. A lot of regulatory changes which we've seen over the last so many years, which in a way makes the whole from a disclosure perspective, there is a lot more of disclosure than what we used to have earlier. From a product perspective, there is more specific disclosure on the extent of risk that you take, both from the interest rate as well as from the credit perspective. So a lot of enablers have been already provided in terms of enhancing the participation in the fixed income space. But then to some extent, you potentially see these cycles where, what we have seen is, you have a phase where duration as a category does well. And then, if you go back a little in history, we would see, 2013, we had a negative event shock, the taper tantrum, which in a way, I think, substantially shook the confidence of investors getting into duration. And then we had a large move into credit. You had demand, which in a way accelerated the process of migration of incremental money into the credit focus category. And then we had the events starting from 18 until 2020, which in a way disrupted the credit markets as well. So we've had these couple of, I would say, macro events, which in a way have disturbed the momentum of flows coming into specific category of various funds. But I think from an overall perspective now, over a period of time, people have actually seen both sides, that, what are the type of risks that you can have on the duration side, and what are the type of risks that can potentially come from the credit angle. So I think from that overall learning perspective, I would say as the next cycle comes up, people would be far more, I would say, informed about the essential risk attributes of fixed income products. So I would just say that, incrementally the scope is substantial. To some extent, maybe some taxation related incentives would always help to incentivize retail flows into various fixed income funds. But now what we are seeing is, again, probably there is a requirement for investors to have a certain defined return stream. And I think to that extent probably explains this fascination for this roll down or target maturity funds. So, you had FMPs which always was satisfying that bucket, but you don't have the benefit of liquidity. So these category of funds do provide you both. You have a certain defined return that you can sort of identify, as well as the flexibility to move out, or the flexibility of ongoing liquidity. So that's something that is really substantially picked up over the last couple of years. So I think in terms of opportunities, to sum up, there is a substantial scope for fixed income AUM to go up, and especially when you compare with where bank, the risk-free deposit rates, for example, where they are, and the delta is reasonably good now that market rates have actually gone up, and bank deposit rates take a substantial while, or it takes a lag before it sort of catches up with current market levels. So yeah, so these are the opportunities that we see going forward.
Great. Thanks, Rajeev. And now we also have Mr. Avnish Jain. Avnish, we were missing you till now, so good that you could join.
Thank you.
So, Avnish, maybe I can just get you, one point which on the first question Amit had spoken about is in terms of, the risk return trade-off. The spreads were not too wide for, mutual funds to really take that extra credit risk and invest in, say, a AA or a single A paper. And that is why we had, more of AAAs and G-Secs kind of finding a higher share. Now, historically, if you see, while in India, generally AA, AAAs are really the flavor, but, A-rated paper, single A is actually something where, basis much of the research that we have seen is actually maybe the superior risk return trade-off. You get a higher yield and you still do not have a very high default risk. So, and obviously in the last 2 years, when generally everyone was unsure about how COVID will play out and all that, so there was a little a flight to safety, which is kind of obvious. But do you see that going forward? And Rajeev also mentioned about certain schemes. But do you see that going forward, there will be increasing appetite in quest for yield, higher yields, that the investments in A-rated paper will kind of return?
Let me address it in a different way. I think while your assertion that A paper might be a more risk-adjusted return might be superior, I think if we look at the mutual fund structure, we are open-ended funds where redemption can happen any day. In terms of liquidity, probably anything below AAA is not liquid in the market. And I think all of us have been in the market for donkey's years. And we haven't seen any major improvement in liquidity of corporate bonds below AAA. I think that is the main risk I see from a fund perspective, that if there's any Six Sigma event where there is a run on fund, or in terms of liquidity, there's sharp withdrawal of liquidity leads to redemptions in funds, then liquidating credit funds it becomes a big issue. And as we have seen in 2020, it has happened, and then the funds had to be closed down. So I think that is one of the major risks of running credit in a mutual fund structure. Definitely, if you're in a closed-ended scheme, you have more leeway. But again, the investor does not have a liquidity per se. So from a liquidity perspective, I see a lot of risk, and from risk perspective of running a portfolio where a substantial portion is AA, or A. That's why we have seen probably in credit funds, the growth is still, it's negative growth over last 3 to 4 years. We have seen a sharp drawdown in AUM of credit funds. Yes, you can have some portion of your assets in credit, but I think substantial part will still remain from a liquidity perspective into AAA and G-Secs or T-bills. And I think with the new regulations, SEBI is pushing in, especially from a risk management perspective. Most of the funds will not have too much leeway in taking credit per se.
Got it. Got it, Avnish. Maybe I'll get Amit back. Amit, so yes, I mean, continuing this point which Avnish is mentioning about, the liquidity being really the negative factor, and that's why maybe the appetite, but is that how, globally, there is, even double Bs and triple Bs really are kind of order of the day. So while I agree, maybe today, tomorrow, it may not happen. But in the long term, do you see, because, we have now so many good quality corporates in A and maybe AA minus or A plus AA minus kind of a segment. And we also, there was one slide that we showed, where the rating actions, even during the last 2 years, if you see, and especially in 22 or so, that was a post, during COVID times, post moratorium year. There have not been too many defaults. So the credit quality in general, if you see, while there were a lot of fears that that there could be systemic defaults and all that, we have fortunately not seen much of that. Now, with that as the background, do you see that there is enough kind of interest that can be created? And mutual funds obviously will have to kind of play that role in terms of getting a little high risk investor, high yield, high risk kind of an investor back into the market. Amit, over to you.
So 2-3 parts to your question, and let me answer that one by one. So first, Sachin, we are sold to the story of single A, so no convincing required there. So in fact, in the new avatar of conservative ratings that we have seen since 2019-20 onwards, first of all, on face value itself, A rating maps to a better quality of credit now. I'm just making a generic statement here than what it was in general earlier, because the credit standards have become much more conservative in terms of application of ratings. 2 or 3 other hygiene factors which have improved significantly more. First of all, capital structures across balance sheets, across rating spectrums have improved significantly. Third, I think the company balance sheets and their operations have resulted into significantly better operating metrics as well for a lot of these mid-sized enterprises rated A and beyond. As far as rating migrations are concerned, partly driven by these things, partly cyclical. To that extent, maybe the FY21 rating migration story is a one-off story purely based on the extent of migrations. But definitely, we are in a much better wicket today than where we were earlier. So I think completely buy into that story, and there is absolutely no convincing required there, and we are fully in it. I think there is, so first of all, like I said at the beginning, I don't think there is a lack of risk appetite per se. Okay, so I think what has happened is threefold. First is that in the narrow context of flows into credit risk funds, we have seen a drop. This, I think, has happened because of three reasons. First is that what Avnish touched upon, that the regulators have mandated a certain amount of threshold liquidity across products, including credit risk fund. Second being that huge amount of TLTRO-led borrowing and huge liquidity surplus-led borrowing reflected credit rates and spreads which are not commensurate with the risk, and hence credit risk funds were not as a portfolio able to generate that kind of a YTM differential over high-grade funds which could justify the risk-return trade-off. If you go back historically, you would see that these spreads were in a range of 150 to 200 basis points, which today are around 75 to 100 basis points. Third, more importantly, there is a semi-permanent factor here, which is the optics part of it, which is also to do partly with what Avnish mentioned around liquidity, and partly to do with the fact that investor appetite has only been slowly coming back, and hence fund houses have been slightly more conservative from an optics perspective as well. All these three things put together have meant essentially that when investors are taking credit risk via the credit risk fund category today, the relative differential of benefit that is getting earlier versus today is to the tune of 75 basis points lower than what it was earlier. On a base of 6 to 7%, 75 basis points is a reasonably large number. So this will get corrected over a period of time is what our sense is. And as I again said in the beginning, it's not that investors have lost risk appetite. You look at direct bond buying and you actually look at wholesale market pricing for some of the debentures that are being placed. Compare that with pricing that is happening in the ELD space, for example, you will clearly make out that people are willing to take that same risk at lower yields than what is available in the wholesale capital market space. So it's not about risk appetite. I think it is about some changes in the credit risk fund structure, which has led to some drawdown in yields, some conservativeness which continues, which is not necessarily a bad thing. It's just that I think it will slowly start changing now. It has started changing and will start changing more. And third, let's face it, I think as an industry, we will have to go through that grind of reconvincing the investors to come back into a space which between 2013 and 2018, as Rajeev said, was the darling space as far as retail investors were concerned. But since 2018, or especially since 2020, both because of funds getting locked in some instances, and also in some instances because of absolute capital losses, there is you can say some kind of a deficit in terms of how investors approach this category. That deficit will get covered over a period of time. So I think it's more a timing issue in my mind rather than a category issue. And I don't think it will sustain beyond the next 1 to 2 years.
Got it, Amit. Thanks a lot. Rajeev, in terms of, duration, right? You did touch upon that. Right now, obviously, with interest rates a little uncertain, maybe mutual funds would, really want to keep money on the lower end of the duration. But, one need which the market has very clearly is on the long-term capital of, say, for infra and, whether or maybe InvITs, REITs and all that. Now, these are instruments which, if you were to look at 5 years back, the infra story was all negative. But if you see now, the ratio of operational assets, the risk sharing between, say an NHI versus a sponsor, it's kind of a little covered situation, say whether you look at HAM or TOT and other things. Now, in that case, do you see mutual funds kind of playing an active role in kind of funding? Because mostly the issue comes in, mutual funds typically want to lend 3 to 5 years, and these guys maybe want 10 to 15 years. So now how do we bridge the gap, or do you think that's something which is difficult kind of mountain to climb in a way?
Yeah, so maybe I'll try and connect this with one very important point that Avnish brought about, that was on the liquidity aspect of some of these lower category or lower rated bonds. Now, when you look at actually the holding pattern of corporate bonds, I guess about 65-70% of the outstanding bonds would be held by insurance and PF industry, and probably about 15-16% is what the mutual funds and maybe banks also would be holding a similar amount. But the larger amount, the bigger point here is when you look at the market liquidity, a large part of liquidity is actually provided by mutual funds, who are just about 15-16% of the outstanding holding. So the issue about increasing liquidity in some of these bonds, which would definitely, I would say, enhance the ability of mutual funds also to get down into the credit spectrum, would happen when this larger segment, which is 65-70%, if they incrementally at least start to do an active approach, or at least they are actively present in secondary market. It's a tall ask, I know, but then I think until that framework or until that enablement is in place, we will always come back to the same question as to why there is very little liquidity in the below rated category of bonds. So the same, I think, would again apply onto your question with respect to funding longer term infrastructure. So, for example, mutual funds have always been there in REITs, or in which the bonds, which are typically 3-5 years borrowing, which is effectively what fits in with our liability framework. But longer term lending, very clearly, that's not probably the space where mutual funds can really be actively present beyond a level. Maybe in some of the hybrid products, which typically don't have a very concentrated liability, one might be able to take long dated debt. But I guess that's a space which has to be occupied by longer term investors, which is in a way today most of them follow. In fact, all of them have this mandated investment pattern which effectively leaves out very little scope for them to go beyond the high grade and sovereign. I think that's the missing piece that we have in our bond market, that people who have the liability stream, who can take that potential illiquidity, they don't participate. So
you're referring to largely, say, insurance companies, right?
Yeah, insurance, PF, the people who have the longer term liabilities.
Yeah.
And at the same time, even today, when you look at InvIT units, we see very little of domestic long-term participation there. You've got a lot of offshore or foreign pension funds who are actually holding the units, and some of us on the mutual fund space, we have taken exposure to units. But again, it's a different category that should actually come in and take the lead there, and that's definitely not the mutual funds, or it's not for mutual funds to actually be taking the lead there. I mean, for longer term lending, especially for infra.
Got it. Thanks. Avnish, like infra is one segment, which is kind of capital starved and needs, other sector is the NBFC, the financial services sector, which again needs equity, the debt on a very regular basis to fund the growth. And some of them are really growing very fast. And now if you see the fear that we had maybe 3-4 years back is now kind of returning to a bit of normal in terms of collections, deleveraging, in most of the balance sheets that we see on the NBFC or the HFC side. How do you see that kind of playing out from a mutual fund investments perspective?
Sorry. I think definitely a lot of improvement, and as Amit also pointed out, balance sheets have improved drastically over the last couple of years of all big NBFCs. Even going into 20 after the pandemic, there was fear that there will be large scale NPAs, which did not materialize, and NBFCs, in fact, if we see 2021, the growth were pretty muted, while I think the collection drive was much faster. So I think overall, the outcome was that most of the large NBFCs were able to weather the pandemic storm with minimal problems. And we don't see any big problem with the fast growing NBFCs. I think RBI obviously in the past few years had put a lot of regulations, especially related to recognition of NPAs. Last year also they brought in a regulation for recognition, which again, obviously it was a little tough, but I think most of the people complied without much change in the numbers per se. So I think overall NBFCs are moving in a direction where leverage is reasonable with collection efficiency being much higher. These are broadly, I'm talking about the large NBFCs who are basically more diversified on the retail side, etc. On the very specific microfinance and all, we don't invest that much. So probably I don't have that much idea. But I think overall NBFCs last one or 2 years, I think definitely they during pandemic there was a lot of fear, but that was unjustified, and people did get out and did well in the last 1 year itself. Probably the lower rates also helped a lot, where very, very low rates for 2 years have helped NBFCs to manage the whatever extra kind of NPAs were created during that period of time. So I think they have come out strong. So in the top NBFCs, if we look at the large cap NBFCs, we don't see much problems there.
Got it. Amit, your thoughts on the same?
Pricing wise, I think they were not looking very attractive, especially down the curve till very recently, because they were getting a lot of cheap funds. First of all, demand was low, like Avnish mentioned, through 2021 calendar. A lot of them were not growing as aggressively. Collections were reasonably good. The second wave of COVID was much better than expected in terms of eventual outcomes, barring 1 or 2 subsectors like MFI, etc. But the pricing was not great. Demand was low and pricing was not great, and it didn't pay much to actually do a lot of NBFCs, especially if they were not being treated more as rate allocations, but being treated more as credit allocations. Those things are changing now. I think early days yet, but bank lending rates have started inching up. They retain their same healthy balance sheet. Disclosures are much better. The most of the pain of COVID, including delayed pain in the form of restructuring, etc., one way or the other, the true colors around those part of the books are also quite visible right now. So, in a nutshell, a reasonable ground to invest in or slowly start investing in down the credit curve as far as the NBFC space is concerned. As far as the higher rated NBFCs are concerned, I think still I would imagine that spreads need to be wider for us to have incremental appetite beyond what is bare minimum asset allocation in this space. That's how I would look at it.
Got it. Rajeev, you were mentioning about how maybe the long-term liability funded say insurance companies or PF, they should maybe play a more active role in terms of this thing. So, I mean, just drawing that a little further, in the overall, say, deepening of bond markets, kind of that's a off debated, kind of subject. But if you were to really see, you've been looking at this for long, from a regulatory perspective, are there, we used to have, do this, do that. Are there any asks that you feel, if they were to happen, then it would really kind of deepen the overall bond market? Because I personally still feel there's a lot more scope of disintermediation. There are, corporates on one side, and there are, vehicles like mutual funds on the other side, and even direct investments can kind of happen as we speak. So do you see that something which will get people to do a lot more bond issuances? And yes, mutual fund is one way. It can be even outside of that. How any asks or any this thing that can happen from a regulator's perspective?
Yeah, in fact, disintermediation is an inevitable phenomenon. In fact, there are a lot of regulatory enablers or push to actually get more issuances on the bond market, right? All those large exposure framework and some of the other SEBI norms that mandate a certain minimum amount of issuance through the bond route. So I think there's a lot that you've done to enable the supply side. But what about demand? I mean, and I would start by even from a demand on the retail side. So I go back to the earlier wish list, if any, that one could potentially incentivize retail investor demand through mutual funds for corporate debt through some better or maybe through some tax enablement. On the other side, I would say the regulatory norms that govern some of this mandated investment, I think it needs to have a little bit more flexibility than what is there today, because the current rules very clearly force or push a lot of or push their incremental investment into high-grade assets or sovereign. I think there needs to be two things. One, give reasonable fungibility, which is probably lacking at this point. So, and some of those regulatory changes don't happen overnight, but I think that's a direction that we need to go towards. So more than pushing the supply side or getting more of issuances, I think the focus incrementally needs to be on how do you enable the demand side, which I guess is not really happened to the extent that it should have happened so far. Because every committee that you set up on corporate bond market, deepening the market, it only talks about how you get more supply. It does not even give you any suggestion as to how do you incentivize demand. So I think we need to go back to that basics to move forward on this.
Got it. Got it. Maybe a little less regulation would help. I mean, because the sense I got is that, you have to now kind of maintain so much of liquidity and all that. And obviously there have been incidents in the past, all of us know, which maybe kind of doesn't give confidence to the regulator. But I mean, that's the point, because even as an individual investor, you have no choice but to invest in, and if you do not want to take too much of risk, you pretty much have a bank deposit, which is like 4-5% kind of a thing. So there is a huge thing available, which is where I see that the opportunity, even if someone who's getting 4, if he gets 8, that's pretty much the double return, without really taking too much extra risk. So yeah. So on the interest rate side, that's the last question from my side, and then we will kind of open this thing. Now obviously in the current times where interest rates are kind of, the whole world is grappling with it. Or rather, we are not sure, how steep will be the rises further. In that kind of a position, for a fixed income fund, it's kind of tough, right? I mean, you apart from really reducing your duration, I mean, can you really manage the risk any other ways and kind of give confidence to the ultimate investor to not have capital losses? I mean, there was a whole talk about interest rate swaps and all that. I don't know how much is it used in the markets today, but that was I think many years back it was launched. So pardon my ignorance on that, but maybe I don't know, Amit, if you can throw some light on that, or anyone who has a point of view there.
I guess everyone can come in on that, but I don't think we need to make it so complicated to involve interest rate swaps into this discussion. Okay. Let me put it very simply that any intermediate duration product which runs a duration profile of 1 to 3 years, if the investor stays for 3 years and beyond, which is generally what the investors do, you will invariably end up getting better than what you started with in terms of carry returns and not worse. That is invariably true, and you can do as much back testing as you want. But the fact of the matter is that life is not so simple, because everything gets mark to market on a daily basis. So I guess the narrative, to extend Rajeev's answer also, or to suggestion also, the narrative needs to change in terms of valuations. The narrative needs to change in terms of treating everything at the same level. You put money in a 6% bank FD, if the interest rates go up, you don't market to market, you are happy with your 6%. What you don't realize is your opportunity cost is at least 1.5%. The mutual fund makes you realize that by showing you a capital impact on that 6% portfolio, and on a real-time basis, you start getting a carry of 7.5%. That's the difference, right? That is the difference that we need to educate investors on. And if we can do that education successfully, I think a huge amount of migration will anyways happen. And to the extent regulators can enable that in terms of at least uniformly implementing valuations to the extent possible, at least in the non-retail category to start with, is something that should be immediately done, because that's the only way that the efficiency of mutual funds can come forth and be understood by retail investors in a much better manner than what they understand today. Got it,
Amit. Thanks. Avnish, Anything from your side? Yeah.
Yeah, I think Amit pretty much covered the issues with the fixed income. One is fixed income is something which difficult for the retail investor to understand because they've been raised on the fixed deposit scenario for a number of years, and telling them that when rate goes up, price comes down, and both these things is extremely difficult. I think definitely, like Amit said, it is incumbent upon the industry itself. I think from our side, education of retail investors to whatever extent we can do on the fixed income side is will go a long way in ensuring investors that you are not losing money. Actually, it's just a mark-to-market impact. And like he pointed out, 3 years is anyway tax efficiency kicks in, and in 3 years you will get what you over a longer period of time you will not really lose money that way, or capital loss in most of the cases, unless you are hit with a credit event. So I think from that perspective, that kind of story needs to be told. And like Rajeev was talking about earlier, that on the targeted maturity funds, if investors are okay in investing in target maturity funds without looking at it on a daily basis, I think if they have the same mentality when they are investing in open-ended funds as well, I think it will work out. Because if you invest in a targeted maturity, I'm sure people don't come back to you every month saying that, okay, this month movement is positive and this is negative, because they know that after 3 years or 5 years, they will get some defined return or whatever was market level. But they ask the same questions when you invest in a open-ended product. I think it's the same concept. Optically, obviously, you need to just work on that.
Got it. So maybe we will, kind of pause the moderated panel discussion. I will request Mradul to kind of, announce to the audience for keying in the questions.
Sure, sir. Dear participants, now we are opening the floor for your queries, please. You are requested to please key in the questions in the panel if you have for any of our panelists. Thank you.
Okay, I've got the first question. It is with AIFs becoming more popular, will the smart money move out of mutual funds? Maybe Rajeev, you want to take that?
Yeah, so to some extent, you could say that given the tightening in regulatory norms, especially on the credit side, you will over a period of time see some of the money that is chasing high yield, or even when you look at the investment side, some of the high yield investments, structured investments that earlier mutual funds were doing could potentially migrate into the AIF platform. So that is, I think, an inevitable consequence of the last 3 to 4 years and the fallout in terms of the regulatory changes that have come upon.
Got it. Amit, any thought from you?
I think what Rajeev is saying is perfectly right. AIFs would reflect some concentrated part of the mutual fund portfolio, which was high yielding and beyond. Obviously, AIF is also very, very wide spectrum, starting all the way from 9% going all the way up to 21%. As the various nuances from pure credit to venture to convertibles to stress to special situations, so on and so forth. But I would just step back and say that I think there is reasonable space for both to coexist. And the corollary I would draw here, again, I go back to the point that if you actually look at the amount of direct buying that has happened in bonds and the kind of bonds, the category of bonds that have been purchased by HNIs, retail investors in the last 2 years, it will tell you that that appetite has predominantly been in the single digit spectrum. mostly in the AA and single A space, and mostly driven by want of higher gross carry, but not necessarily of the type of risk appetite that would potentially be populated in a variety of AIF schemes. So I guess both sides will exist. When you talk about smart money looks at doesn't look at the gross returns. Smart money also looks at the net returns, net of fees, net of whatever different types of fees that AIF industry charges, net of taxation, so on and so forth. So to that extent, yes, to those AIF products which could create that differential on a sustained basis, it will happen. To the extent that mutual funds almost semi-permanently lose the appetite for some types of credit and structures. For example, unlisted is now permanently out of the industry. For all practical purposes, the promoter funding bucket is out of the industry. So there are some such buckets which are permanently moved out, which will get populated in the AIF space. Some AIFs will create that value. Those who can will see that appetite. But I think both spaces will coexist.
Got it. Great. We have got a few more questions. So one question that we have got is, what are some innovations with respect to mutual fund products that we can see in the future in the fixed income space? Avnish, you want to take that?
Difficult question. I think mutual fund in India is dependent on your secondary market products, and like when Amit was referring to interest rate swaps, we have been watching interest rate swaps keenly development for last 10-15 years, but the product remains same. So the overnight index swap is the main liquid swap which is there, and it does not have, in fact, have too much correlation with the markets. Yeah, probably not 100%, probably 70-80%. I think what innovations could have been probably on the credit default swaps, which was introduced way back in 2009-10 by RBI, but that did not take off. Again, it comes back to what Rajeev alluded to on the long-term investors having a bulk of investments, and they can only write these kind of products. And till we get some complex products in the basket, apart from doing cash products, either on the open-ended side or on the targeted maturity, which mutual fund has been innovating on the floating rate structures, etc. I think beyond that, it is difficult to come up with very kind of big innovation out of that. So I think we'll continue to do that, but yes, we'll be looking at ways to see opportunities wherever possible. If, say, for example, if regulation or government gives some relief taxation benefits for infra space, specifically for infra space, then mutual funds can take out funds on that category. Especially, I think in the past, mutual fund has also worked on retirement category. I think Amit, they have a retirement funds. So I guess we have been working on, but yes, because of not able to guarantee returns, which some of the other industries can do, it becomes difficult sell.
Got it. One more question. Given the rise in YTMs, will we see debt funds making a comeback in the context of real returns? Rajeev, you want to take that?
Yeah. So real returns over the next, if you're looking at a 3-year, I think both Avnish and Amit did mention earlier in response to your question on interest rate or duration risk. I guess one should be able to get positive real returns provided you have that investment horizon that spans probably the next 3 years, wherein you could potentially see capital gains as well as interest rates settle at some point and then start to ease as we get into the next cycle of rates. So I don't see any issue with respect to actively managed products over the next 2-3 years or a minimum 3-year holding perspective being able to get real returns to investors. So,
yeah, got it. I think we are now getting kind of almost okay. I've got one new kind of question. Maybe this will be the last one. How much weight should a debt fund investor give to the risk? I don't know, risk-on meter and PRC matrix while selecting a debt fund? Honestly, I don't understand the question. I am hoping you guys will understand it. Do you understand, Amit or Avnish or Rajeev?
Okay, I'll answer it. So the PRC matrix is essentially the maximum risk a fund can take according to new regulations by SEBI. And the Risco meter has to be actually the current risk appetite. So I think it's a combination of liquidity risk, credit risk, and duration risk. So for an investor, he can look at these three risks together and see what is the better risk. So theoretically, obviously, the lower the riskometer, lower the risk, but then your return expectations are also low. So a liquid fund will have, or the overnight fund will have the lowest riskometer rating. And probably a gilt fund will have the highest riskometer rating in terms of duration, or a credit risk fund will have a higher riskometer rating in terms of credit risk. So obviously, from that perspective, you are looking at a riskometer. It essentially gives you a weighted average or a simple average of the three risks. Potential risk is maximum what a fund can take without breaching the regulatory limits.
So the question is, how much weight should a debt fund investor give to the riskometer and PRC matrix?
I think it is within funds, one can see if in one category of funds you are looking at, and if the returns are similar in a category, let's say, or they're not differ too much, then you could invest looking at the riskometer and see which fund has a lower riskometer. Then they are able to deliver similar returns with a higher, lower risk. So that is broadly what way one investor could look at. Probably somebody can add something more on this.
Amit or Rajeev, you wanna add further?
I guess the thought process of the regulator behind coming out with the riskometer and PRC score was as follows: that if you have been investing in debt mutual funds for long, you would know that debt mutual funds are typically categorized into 14 or 15 different categories of debt funds. Each category by earlier definition used to only talk about duration risk. The regulator wanted to look at risk more comprehensively and hence came out with a methodology which combined duration, credit, and liquidity risk put together in one single score. Hence, when you are specially looking at a variety of products, and sometimes investors do tend to get confused because of, we use 15 into 4,600 different schemes, open-ended schemes from the industry. And a lot of schemes would have common names. For example, I, Rajeev, and Avnish would have invested in a State Bank of India bond across many of our schemes with differentiated mandates as well, right? And everyone's scheme might or might not carry a different name also as far as the scheme name is concerned. So how does an investor then figure out that if he is a low risk investor, is there one single score that he can look at which will tell him, broadly speaking, and this is not the only accurate definition of risk per se, but this is an enabler as far as the investor understanding is concerned. One score for a risk risk profiling of a scheme. As Avnish mentioned, if it is a riskometer, a lower riskometer score means this scheme is low risk and vice versa. And as Avnish also put it out very clearly, this will be applicable uniformly across all product categories. So you might actually have a situation where a low duration fund might actually have a higher riskometer score as compared to some floating rate fund or some short-term fund, depending on how the fund is constructed and run, right? So that helps the investor parse through these plethora of scheme categories and names, use the single riskometer number, and figure out what is the risk profile of that product. But as Avnish mentioned, so would be the return profile of the product. So lower the riskometer score, by definition, ceteris paribus, lower the risk, return potential.
Correct. Okay, great. I think that is a right moment to kind of on such a heavy question. I also learned something new here. So great, thanks. I will just hand it over to Mridul to do an official vote of thanks. Over to you, Mridul.
Thank you, Sachin, for moderating this session, and Geeta for a presentation. And thank you to our guest speakers, Mr. Rajeev, Mr. Amit, Mr. Avnish, for your insightful views. It was a privilege hosting you. And thank you again to all the participants for taking the time out and being part of this CareEdge webinar. For any further queries, feedback, or suggestion, you are please welcome to write us in the suggestion mail, which will be coming no sooner the webinar ends. Thank you and goodbye for now. I request the tech team to log off, please.
Thank you. Thanks, everyone. Thank you.
Thank you.
Thank you.